I think YouTube is changing this a little bit, and I think platforms like M1 Finance, Robinhood, Webull, Trading 212. I think the combination, actually the combination of a bunch of factors, I think is combining. So you have these free trading platforms, you have YouTube, but those are only two of the factors. You also have the low interest rates. So I think slowly people are catching on, or maybe quickly people are catching on, that putting your money in the bank is not really helping. You know, it's not a good solution. It used to be a good solution, actually, a long time ago. You could put your money in a bank, it would earn 5% interest, and you could grow it. You could actually grow it. But since that's no longer true, I think that the combination of the low interest rates, YouTube, the free trading platforms, they're all coming together. Maybe contributing to that is also the kind of situation that the younger you are, the greater the disparity is between your debt and your wage. So there's this gap between the rising debt and the wage, the starting wages, and that gap is getting bigger over time. So like, for example, student debt is now the greatest it's ever been in its history. And housing, the cost of housing is also the greatest it's ever been in the history of housing. And the wages, the starting wages, have not matched those expenses. So you have the sort of the coming together of all these different factors. Probably you have cryptocurrency also accelerating this change, because you have these stories about people getting rich off cryptocurrency and that sort of thing. So I think all of these things are coming together and maybe affecting financial literacy, you know, at least having some influence. I don't know how big of an influence, but I think there is some influence. Certainly I have been influenced quite a bit by all of these factors. So I'm just assuming, since I have. On the other hand, the YouTube channels I follow are very, very successful, and they're growing very quickly. You know, like Joseph Carlson is growing like wildfire. And he's in a position now where he can quit his full-time job just because of his social media activities, which is, you know, and that only happened in like 2 years. So, and there was another guy, unfortunately, he stopped his channel, but Kenny Robinson, who I mentioned before, he was growing very, very rapidly, and then he stopped. I don't know exactly why. He said that, you know, he stopped because he ran into a conflict of interest. He was trying to acquire a company that was making stock recommendations, and it was conflicting with his own personal views on YouTube. I don't know if that's really true or not, but at least that's what he said. So he stopped. But his channel was growing very rapidly. You have Andre Gic, another finance YouTube channel. His channel's growing rapidly. There's another guy I just discovered. I don't really think, I'm not a fan or anything, but he's very popular. He runs a channel called Financial Education. Probably Wang knows a few more sources.
I think we should have finance resources as opposed to visualization.
we do have finance resources, not in the form of a little research paper, but I think that you can get all of your financial education necessary by reading 2 books, the Rich Dad Poor Dad book, the Money Master the Game book by Tony Robbins, and then just watching Joseph Carlson. I think between these three sources, you can get all the education that you need for investing.
Can you write them in the chats? So is it like
Yes, I can. I'm taking minutes actually.
Are you serious?
Yeah. So, Rich Dad, Poor Dad by Robert Kiyosaki.
Yeah, I know this book. You already mentioned it. And by the way, there is an arbitrage with this. Yeah.
There's Money Master the Game by Tony Robbins. And then there's the Joseph Carlson Show. And yeah, I think between those three, of course, I do a lot more than that. Like, I've read a whole bunch of books, at least 10 books. You know, there's another classic one called The Intelligent Investor. This is the one, I would say this is the most popular one, probably. But after a while, they start to turn very repetitive.
Yeah. I think I understand that. Yeah.
The Intelligent Investor is a very popular one because Warren Buffett is always endorsing it. He's always saying, read The Intelligent Investor. And it's also very old. You know, the first edition was published in like 1960s something or whatever, maybe 19...
I guess these books like don't get old. They always like apply.
I don't know the answer to that. I think the first edition of Intelligent Investor was written before index funds and ETFs were even available. So I think that it is good to read some updated material. Like Money Master the Game is comprehensive and updated. So that's why I think it's essential. Yeah. It's really yeah. So Rich Dad, Poor Dad is theory. You know, it teaches you about the difference between an asset and a liability. Money Master the Game is then applied. It's very applied. Like, you know, invest your money in these index funds, have this kind of a portfolio. And it introduces other topics, really other important topics like insurance and financial advisors, how the average family spends their money, like what do people spend their money on typically, what does the average person have in debt, and so on. But he's all about the index funds. And then Joseph Carlson actually he's extremely applied, right? He's showing you his portfolio, his actual portfolio, and he's always choosing, well, not always, but he's actually talking about individual companies. And I prefer the individual companies, but most people prefer index funds. And probably someday I will buy some index funds. I just haven't done it yet. One of the reasons I don't choose index funds is because I don't want to invest in some companies. Like, I don't want to invest in Coke, right? Coke is probably part of every index fund. Same thing with McDonald's and like Microsoft. These are three companies that I really don't want to invest in. I don't want to invest in, like, what's another one? ExxonMobil or BP, you know, the oil companies. And these are usually featured in these different huge, like, S&P 500 index funds and so on. But yeah, most of the books will say put your money in an index fund. You know, do that because it's safe and it will grow, and you don't have to worry and you don't have to pay attention and all that stuff. And yeah, that's fine. That is, you know, there's nothing wrong with that.
I think this is most of the guy that I just told him that we are. This is most of what he says. Is he doesn't like selling and buying the same day or like all same week or month.
Mm-hmm.
He wants you to invest for a long time. So I think he always mentions lots of reads, and I just visited his website, his Twitter account again, and I saw two recommendations.
Okay.
The richest man in Napoleon of this, and I sent them. There are two books he recommended, along with the book like Rich Dad and Poor Dad and Intelligent, Smart Intelligent, Smart Investing.
Richest Man, yes, I have read The Richest Man in Babylon. I have not read The Secrets of the Millionaire Mind, Mastering the Inner Game of Wealth. That sounds like a good book. I bet, just by looking at the title though, I bet I know what that's about.
Yeah, he just mentioned those books. They all have Arabic versions. I just translated the name of, and shows in Google.
Yeah. Yeah, there are some books that everybody recommends, like The Richest Man in Babylon, everybody recommends this. There's one called Think and Grow Rich by Napoleon Hill that everybody recommends. I personally don't recommend them. Or they're not essential. Like, you can read them just for fun. You know, they're fun books, but they're definitely, in my opinion, not essential. And I think a lot of people recommend these books just to sound smart. Like, check me out, I'm so smart, I can recommend this book. I think a lot of people do this in social media. Like, look at me, I've read this book and I'm recommending this book because I'm so smart. Like, check me out. And it's not because the books are that great. It's just, when you make a book recommendation, it just makes you sound smarter.
You mentioned these three books, the two that I just paused,
Yeah.
and Rich Dad, Poor Dad. And why he did this, he mentioned these books, the Arabic versions, and suggested them as a gift for your kids.
I see.
Yes.
Okay.
So it's just emphasize the points that we just mentioned. That he always emphasized it. We lack this
knowledge.
This knowledge in our kids, especially I think in some area.
I would not. I don't think those are good gifts for kids.
Yeah, he said. An advice for dads and moms: please give your kids such books.
Yeah.
Have a discussion about them because they were raised concepts, financial concepts, and the value of money.
Yes.
Teach them to benefit and will benefit them in their futures. And you mentioned these three books.
Yeah, I personally would not get those books for my kids if I had kids. I think a better thing to do for a kid, like a child, is take that money you spent on books, buy one share of Apple or one share of Realty Income or your favorite company, put it in a portfolio under your kid's name, and then show that to your kid when they turn 18 or 19 and say, look at what I did. I took $50, and I grew it into $1,000 or something over the span of 10 years or whatever. I think that would be a better thing than just buying these books that the kids are not going to appreciate when they're so young. It's like, it's too early. Well, at least that's my opinion. Like, I do. Well, I do think like Rich Dad Poor Dad talks a lot about this, a lot, and it actually starts from childhood. You know, he's like 8 years old when his rich dad starts teaching him about finances. But he doesn't say go read a bunch of books. He's a strong advocate for applied knowledge, like go out and get a job, you know, go earn some money, go do stuff. Don't read the theory. And yeah, I don't know. That's a big topic. It's a big topic. But some of those classic books like, you know, Think and Grow Rich and Richest Man in Babylon, I don't think they're necessary at all. I think Rich Dad Poor Dad, that's a good one. Like I would say that is a necessary one. Yeah. Like in Think and Grow Rich and in Richest Man in Babylon, there's no concept of asset versus liability. I think the asset versus liability concept is profound. It's absolutely profound. And this concept has changed my complete view of the world. Like, you know, your liability is someone else's asset. Basically, so everything in the world can be viewed through the lens of liabilities and assets. And who somebody is trying to sell you their assets or their liabilities. It's like these assets and liabilities are moving around, you know, and so you move into a rental property, it's somebody else's asset and now it's your liability. Like, or you know, these assets and liabilities move around in a very dynamic environment. And you have to be able to see the environment in the lens, through the lens of these assets and liabilities. That's my point of view, and that's Robert Kiyosaki's point of view. And if you can't see that, you are just going to be on the liability side your whole life, and you're never going to be on the asset side. And yeah, that's in my opinion, that's really profound material. I would think about the Rich Dad Poor Dad book for my kids. I could imagine sitting down with my kids and like reading a chapter from that book, because the book actually had. What's that?
Bedtime story.
And like the book has children in it. There are children in the book. They're working in like a little shop and they're selling comics and things like that. They're buying comic books and they're trying to start a business, a library with comic books in it. And yeah, it's a really a classic one. It's a classic one. Okay, let's see if I can share my portfolio and get Wang's wisdom.
Another important topic is patience.
Time.
No book is patience.
Yes. Yes, in some ways I also think, can you see, oh, it's starting. Let's see. Can you
By the way, Mark,
yeah.
I just looked at Rich Dad Poor Dad in Amazon.
Okay.
Yeah. Did you buy the actual book or you used audiobook?
Both. I start with the audiobook, and then if I really like the audiobook, I buy the printed version. Yeah.
Okay, there's a hard copy of like 70 pounds.
Oh, that's...
Yeah, and there is like mass market paperback for 6 pounds.
Yeah. Yeah, 70 pounds is way too much money. I wouldn't pay 70 pounds. That's a liability.
Can you move without one more book?
Yeah, but I often buy used books if there's a substantial difference in the price between the used and the new. Then I buy the used ones. Can you guys see my screen?
Yes.
Okay, great. Okay, so Wang, how do you want me to sort this portfolio?
You, up to you.
I could sort it by
Yeah.
symbol,
Do
or
you actually update all your like stocks
yes,
into 16 alpha?
yes, I do. I use Seeking Alpha. The reason I'm using Seeking Alpha is to get an overview. It's because my portfolios are a little bit distributed.
Just I'm already past that stage.
I
Just
know.
don't care.
I want to have an overview because they're distributed. Unfortunately, I have an interactive investor account which I am transferring. I only have one more step, as you know, and I am going to try that in January. I'm hoping January will be a quiet month on the market, and then see if I can transfer my ISA over to Trading 212. And so I have Trading 212, Interactive Investor, and then M1 Finance, the US portfolio. And so I try to keep an overview on Seeking Alpha of everything. And I can say that this Seeking Alpha, I have not done a very good job of entering all the data perfectly. One of the problems I ran into is how do you represent dividends and dividend gain in Seeking Alpha? There is no mechanism currently, explicit mechanism to represent dividends in Seeking Alpha. And so what I started doing is in the beginning, I would take dividend money, buy shares, and then update my Seeking Alpha portfolio, but I was not counting those as gains. I was just entering the price information as if I had purchased them with my own active income. Really, what I should have done is purchase them as gains, as dividend investments, rather than with my active income. So that unfortunately is not reflected in this portfolio. So it's a little bit off. I think the most fun is probably to sort by percentage gain. Probably that's the most fun. You'll be pleased to see the second highest gainer, which is .net. It looks like net is going to pass Beyond Meat in terms of gains in the not too distant future. I think Hand & Armstrong sustainable. I think you're roughly familiar with Hand & Armstrong. Pretty conservative. They pay a great dividend. Nobody talks about them. They're never in the news. They're kind of under the radar, but they're doing really well. I got that last year. Nike, who knows why Nike is doing so well? If anybody can...
You got it good time, I guess.
I don't know. I don't know what's going on, to be honest. They're not in the news very much. I think Nike is all about brand loyalty. Like, I think people just love Nike, the brand, so they are very loyal. That's my guess, but I don't have a solid reason. Another one that's really outstanding, that's really boring, is Hillenbrand. I think I've mentioned this company before. Also, this percentage gain is not very informative because I've purchased Hillenbrand 3 times. So the original shares are over 100% from last year. Hillenbrand is super, super boring. It's basically like two companies. One part is focused on materials engineering with a special focus on lubricant for industrial machinery, like super boring. And then the other half is death care, like funerals, funeral services, casks, funeral insurance, all that stuff hinging around death care. And one of the reasons I bought that is because of the baby boomers, right? There are 10,000. Well, the world has a 1% mortality rate. So 1% of the population dies every year, roughly. This is very rough. So if you look at that in terms of demographics, that's increasing every year. So death care theoretically should be quite a good investment. And of course, those death care companies are always raising their costs, right? Of course, there's Apple. Disney is suddenly doing extremely well, but I can say they were doing well even before the streaming service started. But now that the streaming service is, full speed ahead, Disney is going forward. Unfortunately, they're not paying their dividend right now. Clearway Energy, also another sustainable energy company. And also this percent gain is not perfect in the sense that I've bought it multiple times. So the original shares are up probably close to like 80% or something like that. Costco, you guys know about. Expedia, I thought Expedia would be a good purchase because I was buying it during the dip. Caterpillar, very safe, right? You guys know about Caterpillar. It's a big construction. Very safe. They pay a good dividend.
Engineering, materials.
Yep. They have a little bit of, they don't have a monopoly, but they have a very strong leading position in their industry. Of course, Qualcomm, a nice tech stock. Target has been doing outstanding. And again, Target is something I've purchased multiple times. So the 46% gain is it's not, these percentage gains are not, they take into account multiple purchases.
Just a second, guys.
Yeah. Let's see, pets, one of my all-time favorites. I highly recommend pets.
There's another pet-related stock called Qiru. You know about that?
No, I don't. What's the ticker symbol?
I think, let me check. It's CHWY.
CHWY. Okay, Chewy.
Yes, pet-related.
Okay.
The company is called Qiru. So basically, pet food, pet mats, and everything pets.
Everything pets. Do they pay a dividend?
I think so.
I have a bias towards dividends.
Oh, no, yeah, they don't.
Okay.
They don't pay a dividend. I didn't buy them.
Okay.
Saw it on the news so often.
Okay, they're like growing hot in the hot seat.
So the first Google search result says Qiru growth at an unreasonable price.
Okay. I think that's true for a lot of companies these days.
Up over 190% this year.
Wow, that's
this PAT products, nothing else.
Pets has a good combination of very good dividends with capital gains. I've also purchased them maybe 3 times, something like that. This one is Omega Healthcare Investors. I can't, Aslam recommended that one. I put in a little bit of money. I haven't looked into it very deeply. Okay, Home Depot, yes, like 2020 is the year of home renovation. So Home Depot is a good investment. Simon Property Group is a mall REIT, so there's a little bit risky there. And I just purchased that recently, like maybe 2 months ago or something like that. Intercontinental Exchange, very safe. I would say that's a very, very safe one. The disadvantage there is it's expensive, basically. That's a disadvantage with Intercontinental Exchange. Okay, A.O. Smith, the water utility company, very safe.
Well, not exactly utility. It's more like heating.
Yes, yes.
Heating solution.
That's right. That's right.
For cooling as well.
Very safe. Let's say almost like very close to utility. Like what I don't remember what sector they're officially in, but it's pretty close. Let's see, essential utilities. This is I actually forgot what essential utilities is. It's either death care or water supply. No, it might be. I forgot. That's what happens when you have a bit of a portfolio. Essential utilities. They changed their name. That's the reason I get confused. Essential Utilities was not their name until very recently. It's something like death care. I think it's or waste management. It's W. Oh yeah, WT implies waste management. Anyway, they're very safe, and they pay a good dividend. Broadcom, the tech company. There's the Solar Edge. There's the one that I sold last year that I wish I never had sold, but they don't pay a dividend. Seagate, I would say Seagate's quite boring, pretty safe. I bought 1 share of Google. This is an interesting one, the Silvergate Capital one. This is a very new position, and I just bought them because to gain exposure in blockchain and cryptocurrency. So they're a bank that deals with cryptocurrency, and I don't know, they seem to be very hot right now. So I only bought them about a month ago, and they're already up 25%. SCI is death care. So that's very conservative, right? Very conservative. Well Tower, you guys know about. Snow is this kind of new one that everybody's talking about. Facebook, I think that's safe. Then there's the Next Era Energy. I bought them multiple times, so that 20% doesn't really reflect all of the gains so well because I think I bought them 3 times maybe. Then there's the AbbVie, which is very standard. Johnson & Johnson, very standard. Honeywell. I don't know much about Honeywell. It was recommended by...
Honeywell is very similar to Aerosmith.
Okay.
But, they involve in other technology as well. Basically, all the home electronics, gas, central heating, and the smaller one is Internet of Things. They do have smart thermostats.
Okay, yeah.
Carbon monoxide detector and air purifier, etc.
They cover a lot of ground, like a conglomerate. Uber. So that's nice. Uber is finally up from where I bought it, which is nice. It was in the red for a long time until about 2-3 weeks ago. Because I bought it a little bit expensive. I bought it, well, you can see I bought it at $43, $44 per share, which was pretty expensive. Union Pacific, very conservative dividend. Like, you could call that like old man dividend investment. Ecolab, another conservative one. Visa, conservative, very expensive Visa, but you know it's hard to go wrong with Visa. Gladstone is a REIT, very popular. Comcast is, you know, a telecommunications company, US based. I haven't put very much money in them. We'll see. I'll probably put some more in there. I have to double check the fundamentals. CMCA. CMCSA. So CMCSA. Seeking Alpha is sometimes a little bit slow. Yeah, really slow. Let's see. Let's see if this works. I do check the fundamentals every once in a while, just to remind myself of what is going on. And Seeking Alpha makes that pretty easy. Well, I guess it's because Skype is running, it's also a little bit slower. I don't know much about Comcast. I just know that it's very popular in the US and they have some virtual monopolies in some regions.
It's basically a producer of many TV shows.
Okay.
So basically what their business model is, for example, AT&T, they have this, is it called some TV Max or something? Some subscription service.
HBO Max.
Yeah, HBO Max, that's it. So basically they outsource the production of shows to Comcast.
Okay. Oh, I didn't know that.
Produce the shows.
I didn't know that.
So basically, originally, I think Comcast, they were trying to set up their own subscription service. And then the CEO saying, no, we are not going to do that because it's already a hot market. We don't want to compete with everybody else. So instead, we become like the provider of shows.
Okay.
So it's kind of like a REIT because they have their studios, they have their all the venues for TV productions, and they also have equipment. So they actually kind of operate like a REIT.
Okay.
So they let out their devices, their manpower, directors, and everything, venues, studios, to other whoever wants to make
Whoever wants to make a production.
Yeah.
Hmm.
Exactly.
I did not know that about Comcast.
Yeah.
I think they're also a cable provider, like cable TV
Yes,
provider, right?
They are. They are.
Public storage, old man, conservative investments, theoretically recession-proof, Metatronic, that's a good one. I would like to build up my position there. CVS is, I think CVS is do they own Boots? They might own Boots.
Yes. Yeah, they own Boots. Oh, not CVS. That's WBA. Walgreens Boots.
Is it Walgreens?
Yeah, Walgreens.
Walgreens.
The full name is Walgreens Boots.
CVS is very popular. Yeah, very popular. I go there when I'm in the US. I do go to CVS and I buy stuff there. Of course, Fastly. Hopefully, I expect Fastly to go up in the future. Realty Income, Extra Space Storage, another old man conservative investments. 3M, very safe, old man. Slack, finally Slack is also back in the green. Hopefully it stays that way. I bought them at an expensive price. You can see $40. Waste management, very conservative. I just bought some more waste management yesterday. Verizon, very, very safe. I bought a little bit of Netflix. What's your opinion of Netflix?
Oh, I sold them all a long time ago.
Okay, you don't think they have a good...
Price. No, they do have a future, but it's just too high.
It's too expensive.
Way too inflated.
Yes.
I think at least 30% inflated.
I think Netflix, you know, if I didn't think it was good, I wouldn't have bought any. I'm just not sure how much to try to build that position. I think that Netflix, it's like, yeah, I guess everybody has it and it's going to continue to grow. So it is the leader, but Disney, like, I'm sure that Disney is going to be some good competition for Netflix.
Well, I don't think those two are competing in the same, same subsection. Because Netflix is more about modern TV shows, where Disney is basically clinging on its past, all the fairy tales and children and every stuff. The percentage of modern TV shows like something like Game of Thrones is very low on Disney Plus.
Yeah.
But of course they're trying to increase it.
Yes.
At the same time, there are competition between departments within Disney. So once they see we are doing children's business, that's what we have been doing for the past blah 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 years. Why should we change? We're doing so well.
Yeah.
So there is always this resistance within the company, where Netflix is we're doing everything. They even try to compete with Disney. They try to come up with some children's show, but it didn't work out.
I think my question is, how many of these subscriptions is the average household willing to purchase? Like, I think that the average household is fine to subscribe to Netflix and Disney. And then the question is, like, is the average household willing to subscribe to 3 services, like plus HBO Max? That I think
it kind of overlaps.
Yeah, this is the big question. I think it is.
And also you have Amazon Videos. That's a strong player as well, because you get it for free if you subscribe to Prime.
Yes. So far, Amazon Video, though, is really low quality. very, very low quality, like,
Some old movies.
Yeah.
Old shows.
but I suppose I don't know, Amazon can do anything, but it's hard to imagine Amazon seriously competing with Netflix and Disney Plus. But you know,
Mhm.
things can certainly happen that are outside of my imagination.
Netflix does have a very big issue that everybody is ignoring.
Okay.
It's essentially a Ponzi scheme.
Okay.
Because Netflix is doing so many original shows at the same time. So the amount of money they invested in the original series is staggering.
Mm-hmm.
And because they purely run on the subscription, income.
Yeah.
So at the current pace, with the current subscribers, it's going to take them something around 20 years to pay it off. So if they don't attract enough subscribers, they don't increase the base at a certain rate,
Mm-hmm.
they are going to pay, the cost in 20 years.
Yeah.
It's going to cost in 20 years to pay off just the production cost.
Yeah.
So I don't think that's sustainable.
Yeah.
Also, they still have to pay other producers. Not every show on Netflix is original.
Yeah. Yeah. Yeah, it's a big question. It's a big question.
So that's why I sold them, I think, 480 or something.
Okay. So, People's United Bank, this is a conservative one. I keep buying these because I want to, it's very cheap price right now, People's United Financial. It's a bank. It's a successful bank. I think they're a dividend champion or something like that. And most of the banks have been hit really hard in 2020.
Mm-hmm.
So I've been trying to build up some People's United bank position.
I strongly recommend Canadian banks.
The Dominion one?
That's one of them.
Yeah.
I sold them. I bought the stock. I think it's CM.
CM. Mm-hmm.
I think CM. Yeah, Canadian Imperial Bank of Commerce.
Okay.
And I think it's another something called Nova Bank. Let me find the symbol. Bank of Nova Scotia.
Nova Scotia, yeah.
Of Scotia. BNS. It's listed on I think NASDAQ as well.
Okay. Do they pay dividends?
Very high dividends.
Okay, that's nice.
Those two are like the essential part of Canadian pension system.
Okay. Mm-hmm.
So it is reported that I think the state pension scheme invest almost 40% of its money in Canadian banking industry.
Okay. Mm-hmm.
And they all pay very high dividend. And I read an article on Seeking Alpha. Canadian banking industry is one of the most rigorously regulated banking industry in the world.
Mm-hmm. Mm-hmm.
It
Yes.
recovers very well from the 2008.
Okay. Mm-hmm. Crisis, yeah.
Yeah.
I know that Joseph Carlson has some Canadian banks. I think he has Dominion Bank and maybe one other.
Yeah, Dominion Bank is TD. That's a good one, but the dividends is slightly lower than others. There are 5 of them.
Mm-hmm. 5 leaders.
The top 2 dividend paying banks.
Mm-hmm. Mm-hmm. Store Capital is another REIT, right? Very popular. Currently growing. I just bought Store Capital like 1 or 2 months ago, and been building up that position. AT&T, old man purchase. Merck, very safe. American Tower Corporation, very safe. These are kind of risky ones. The M REITs, right? New Residential Investment Corp, risky. Annaly Capital, I just bought some more Annaly Capital like a few days ago. Risky M REITs. These M REITs have very high betas, very high fluctuation in prices, and they pay like 10% dividends. So it's the trade-off. It's like you have high volatility with a high dividend. And there's another one. This is the most risky one out of the M REITs, the New York Mortgage Trust. So I don't know. I'm not sure about this one. Like this one, I'm not sure about. I'm happy with these the new residential investment. Like I have confidence, a lot of confidence in Annaly Capital and new residential investment. But the New York Mortgage Trust, I don't have so much confidence in. American States Water, very conservative. It's down in price, but if you look at the fundamentals, it's doing very well. If you just look at the year-over-year growth and the year-over-year profit, it's doing really well. This one's very popular as well, Digital Realty Trust. Long-term care properties, the capital gains are not doing well, but their fundamentals look absolutely fine to me so far. I check the fundamentals, is periodically, and they look really fine. This one I think I'm going to sell. Essex Property Trust. This is the Silicon Valley REIT. The problem is California is doing really, really bad these days. People are leaving California, right? Did you guys see the news? Elon Musk is leaving. Definitely. Lots of people.
Everybody's leaving.
Yes. So I think I'm going to leave too.
Why is that? It's a good opportunity to buy.
I just think I can put that money somewhere else and it will be better off.
Well, but then you still buy so many old man's dividends. That's very inefficient of your money. Money.
It's too old man heavy. Too much old man stuff.
Yeah, I think you can allocate a percentage of money to them, but not so much.
Yeah. So, for example, I could just take that and put it into realty income, for example, or something else. I think I'm gonna bail. I don't like what's going on in California, basically.
But from a so-called outsider point of view, non-American point of view, California is one of the most open, modernized states in the U.S. Is that correct?
Yes, it is. It's supposed to be. It's got like it at some point it had the world's like 10th largest economy or something.
Yeah. Yes. And also it has the most so-called how should I phrase it? I think it's most complete rules of law, legal system and protection for everybody is like, whenever something's come up, California state is always the first one to respond.
Yeah.
And I think that gives the state potential to, it's not even falling, to revive the state.
That's true.
In the future. It's I don't think California is going to fall apart or anything. It's just a temporary pickup.
A temporary dark time.
Yeah, I bet all the hot money is flowing into the state, because if the property price is really falling, everybody will be just snapping them up.
Maybe.
I don't think California will just go down like that.
Yeah, it's a tough call.
Yeah,
it's a tough
and
call.
Also, in some ways, it actually helped solving the high property pricing problem.
Mm-hmm.
If the price went down, the price goes down, there might be more people willing to move into California.
One of the problems with California, one of the reasons people are leaving is the taxes.
Mm-hmm.
So the tax rate is higher in California than the other states.
Mm-hmm. But the income is also a lot higher than other states.
I guess the question is, for what percentage of the population is the income higher? Because I don't think it's true about everybody.
Yeah, that's true.
It's true about the tech sector. But I guess that's the question. What percentage does that represent?
Because the average income definitely pushes up the living expenses.
Yes. It's a good one. It's a good one to debate, actually. And I do tend to agree with you that it's a temporary dark chapter.
Mm-hmm.
On the other hand,
it's not even that dark.
On the other hand, though, when a major company moves out, it's like I don't think they're just going to pop back in. You know what I mean?
Yeah.
Once they move, they're going to start. They're going to stay unless they have another really good reason to move. Because it costs a lot of money to move.
Yeah, and also the all the investors, they are all based in California. Apart from Wall Street.
Mm-hmm. Mm-hmm.
They are, especially in the tech industry, angel funds, everybody is in California. For tech companies that want to be listed, want to go to IPO, it's impossible for them to, not having a presence in California.
Mm-hmm. Mm-hmm. Yeah, it'll be interesting to see how things evolve in California. But certainly 2020 has been a very bad year for California.
Yeah, for every state, actually.
Yes, well, except there are two exceptions. South Dakota, right? South Dakota is fine, and Florida is currently doing well.
Relatively fine.
Yeah. Okay, China Mobile. I think I'm going to sell this one too, actually.
Wow, 35% down.
Yeah. I think I'm gonna basically China Mobile and Essex Property Trust. I bought them both last year in my ISA on Interactive Investor, and when I move it over, I have to sell everything because Trading 212 only does cash transfers. I have to sell everything and then repurchase everything. I think I'm gonna leave out China Mobile and Essex Property Trust and put that money somewhere else. That's my current thought process, at least. And then Kronos, the cannabis one.
Weed company.
Luckily, I didn't put too much money in there. That is my British portfolio, so to speak. And then I have like these here. These are my US portfolio holdings. I don't put them in there because it screws up the gains. It's not, and I just for the fun of it, I look and see what Ripple is doing and Bitcoin. And I can show quickly the US one with the that old Amazon one and all that stuff.
Oh, that was transferred to M1.
Yes, I transferred that out of Wells Fargo, thank God, to M1 Finance. And hopefully we can have a look. I have made some adjustments, and just some small ones. I didn't sell any Amazon yet. I'm still holding it.
There's no reason to sell, I think.
Yes, I think Amazon's going to do well.
Or you can sell like 1 share or 0.1 share per year to avoid tax.
I was thinking about selling something like $1,000 every time they hit a new high. Something like that. Something like that. So yeah, this portfolio, I transferred it over on the 20th of April, which was pretty close to the bottom of the dip, actually, in 2020. So all of the gains look very impressive because it was pretty close to the bottom of the dip. But yeah, so there's Amazon up 30. There's Booking.com. This one is also, PayPal is probably one of the most interesting things in there right now. PayPal is like really, because they started off handling cryptocurrencies, basically. eBay, who knows what's going to happen with eBay. I like Starbucks. Starbucks is offering vegan options now, and they're trying hard to expand their presence in China to counter effect all the crazy lockdowns in the West. And then I bought a bunch of REITs to try to get some dividend action in this portfolio to increase the dividend activity. And I got very lucky because I was buying all these things right at the bottom of the 2020. So like you can see Gladstone commercial up 40%, New York Mortgage Trust up almost double, just because I happened to buy it in April. Qualcomm, similar story, LTC, Annaly Capital. I bought a little bit of Apple, PetMed Express, Realty Income, New Residential Investment Corp, and Clearway Energy, Facebook. These are all very small amounts of money. Broadcom and AT&T. So this one's not very well diversified, but it's more tech heavy, and it doesn't have the old man investment strategy, except for AT&T.
AT&T is fine, yeah.
What's your, so you think more tech, less old man stuff and more tech is your?
Well, I don't think I own that many so-called old man stocks.
Okay.
I don't think I own many of them. Certainly some of them, but I will show you.
Yes. Okay, I'll stop sharing my screen so you can share yours. If I can figure out how.